yeah, so I will actually be getting into the slideshow for today because my goal is to be very fast and very, just right to the point with you guys, because I understand time is very important, right? So I would like to get into this. So as you saw, my first paper, we will be breaking down my first paper. First paper, right? Structural limits of open, high, low, close volume based intraday signals in MNQ futures and a systematic falsification study, right? So that is what we're going to be talking about today. Okay, so I spent about a year testing trading strategies, 14 of them to be exact. Well, actually, I've definitely tested out way more than that, but we'll be looking at just 14 for this specific paper in this specific video, right? And every single one failed, right? Not some of them, but all of them. They all failed. And I want to walk you through exactly what I tested, how I tested it, and what it actually means, right? Because I think the honest answer is more interesting than any strategy that would have worked, okay? And so when we look at this, right, the real question becomes, can you actually find edge in public market data, right? And if you spend any real time in retail trading spaces online, right, you'll hear a lot of confident claims, a lot, right? Opening range breakouts work, volume spikes predict direction, gap fills are reliable, etc., etc. Those are just a few of many, many examples, right? And these ideas get repeated constantly. But almost nobody applies a rigorous test to them. And I personally wanted to know what happens when you do, right? And before I show you any results, I think it would be very important. Before I show you any results, right? I need to explain the rules I used, because the rules are everything, right? And so the first one would be every signal fires at bar close, okay? And the trade enters at the next bar open. This eliminates a common backtest cheat where you pretend you can trade at a price you could not actually get, right? Second rule, every trade gets charged a 2-point round trip friction cost, right? And this covers the bid-ask spread, the exchange fees, and any realistic slippage, right? Rule number 3, I used a walk-forward validation, very important, across all my tests that you'll see across all my papers as well. So I tested every signal on data I had never seen during the calibration phase, very important. And fourth, also extremely important, would be having a t-statistic of 2.0 or higher was required, okay? And I'll explain what that means in just a moment on this next slide, but also keep that in mind, very important, okay? So what does a t-stat of 2.0 or greater actually mean, right? What does that mean? A t-stat measures how confident we are that a result is not just random noise, okay? So think of it like, for example, a signal to noise ratio, right? So a t-stat of 1.0 means the results are weak, okay? And it could easily be a coincidence. But a t-stat of 2.0 means there is less than a 5% chance of the results being a fluke, okay? So that is the minimum standard used in most of academic research. So that's what we'll be using, right? And so the problem is that most retail backtests never really calculate this at all, right? But I made sure to calculate this for every single signal that I ever tested, okay? Because like I said, very, very important right here would be the t-stat. Very important. So now for the signal families, right? The 14 that we were talking about this whole time. So here are the 14 signal families that I tested. So we have opening range breakouts in both directions, a pullback entry variant that we used, two Asia session signals. We have gap strategies, we have volume signals, we have a regime classifier, a news-based signal, a gold futures mean reversion test. We have, and we also have a cross-asset divergence test between MNQ and MES. So the Nasdaq and S&P futures contracts, right? And so each one was tested under the exact same standards to make sure that we didn't cherry pick anything at all, okay? So those are the 14 signal families we'll be looking at in this paper, in this video as well. So what I would like to talk about, right, is here's my core finding, as you'll also see throughout the paper and whatnot. But the core finding is that across all 14 signal families, the maximum gross edge available before friction was between 0.07 and 1.50 points, right? Per trade, of course. But as we said earlier, right, our friction cost was 2 points. So every signal fell below the friction threshold. That bar on the right that you see is the friction cost, right? And every signal, as you can see, is shorter than that, so it's all falling below that threshold. And what I want to really, dial in here is that this is not bad luck. This is structural, right? This is not, oh, it just happened. This really is structural. And I'm going to explain why as we go on, but keep that in mind. This is very structural, okay? All right, so this chart shows the T statistics for every signal family, right? The red dashed line is the threshold of 2.0, and everything to the left of it failed, as you can see, right? You can see that the Asia order block continuation is way out at negative 10.96. That one is pretty bad. It's not just unprofitable. It's actively wrong, right? And which I'll explain a little bit in a moment. But that one bar that crosses the threshold is the gap continuation short, right? With a T-stat of 3.23. It has a win rate of 68% and a mean return of 14 points per trade, okay? And it looks like it passed, right? But it only generated 22 trades across 3 years of data, right? And that's just not enough data to validate, okay? So it fails on sample size. The Asia opening range breakout result is the finding I think about most. The hypothesis is simple, okay? When price breaks out of the overnight Asia session range, it continues in that direction. It's a common assumption. It's intuitive, right? But the T-stat was negative 10.96. That's statistically significant, just in the wrong direction, right? The continuation move is real. It's just that it happens entirely inside the breakout bar itself, right? So by the time any signal fires at bar close and the trade enters at the next bar open, the move is already over, okay? And I'm not capturing the momentum. I'm capturing the exhaustion afterwards, okay? And this is an execution timing problem, and it has broad implications for any bar close systematic strategy on opening range breakouts, okay? And so what we should look at is so we should look at the signal that came the closest, okay? The gap continuation short signal is the most honest result in the study, in my opinion, okay? The statistics genuinely look like an edge, right? We have a T of 3.23, We have a win rate of 68%, right? We have a mean return over 14 points net after friction, right? If this had 200 trades behind it, I would be very interested, right? But it has only 22 trades across 3 years, right? As we said, and that's roughly one signal every 7 weeks, and that's just not enough data to distinguish genuine edge from, a lucky run. And so I did not validate it. I preserved it as a research asset to revisit when more data is available. But that is what that's the key part right there, right? That's what honest research looks like. And these gurus, these trading gurus that you see all over the internet these days, they might possibly find an edge like this, right? But like, say they found this edge, right? For example, they would still go ahead and sell this to their audience, saying, "Oh, this really is an edge that you can trade, weekly, monthly, by day, blah blah blah." But in reality, that's not what the data really shows, because this isn't sustainable over a long period. We only have 22. Trading days, right? And that's just not statistically, that's a sample size error right there, because we just don't have enough days, right? And so we can't validate that. We just can't. And so the real question becomes, if these signals don't work, then why do so many people claim they do, right? And I can answer this in 4 possible ways, right? First, we're using unrealistic fill prices, right? You're using mid-market prices instead of actual bid-ask, right? Number 2, you're just ignoring friction entirely, right? Third, we're looking at people possibly optimizing parameters on the same data you're testing on, right? And that's called overfitting. We don't like that at all. It's a horrible thing. And fourth, you're only publishing the strategies that appear to work, which is where most of these retail online gurus fall under. They're just trying to make a quick buck, and they're selling false information. So if you remove these 4 confounds from any retail backtest, and most edge disappears, and this is not a criticism of anyone specifically. It's just how the incentive structure of retail trading content works. That's just how they make their money, right? Most of these guys that you see online, they don't actually make their money from trading. They make money from telling you how to trade, if that makes sense. But so I want to show you, right? Now I want to show you 2 signals that did pass all my criteria, okay? Because this is the proof that this form of methodology that we're working with actually does work, right? And so I included these as positive controls, so that they're proof that my methodology is not so strict it rejects everything, right? The RTH confluence signal has a T-stat of 5.83 and a mean net return of over 15 points per trade on 538 signals, okay? The London session signal B has a T of 5.15 and a 64.7% win rate. They both cleared all 5 criteria with substantial margin, right? And so the question is, what's different about them, right? And the thing is, they don't use single bar price patterns, okay? They use GMM regime classification, Markov transition probabilities, and hold positions for 12 to 15 hours instead of 1 to 6. And that difference in architecture is the difference between an edge that survives friction and one that does not, okay? And that's a key difference that we want to keep looking at as we look at our strategies, okay? And so why does the ceiling exist, right? Why does this gross edge ceiling exist? And here's the structural explanation for why open, high, low, closed volume patterns fail on a market like MNQ, MES, etc. But MNQ is one of the most actively traded futures contracts in the world, okay? Any pattern that is visible to everyone and reliably predicts the next bar gets traded away by institutional participants who have lower costs and faster execution, right? This is just called alpha decay, basically. The rational equilibrium is that the gross edge of any publicly observable pattern equals approximately the friction cost of the marginal retail participant, right? So that equilibrium is about 1 to 2 points gross per trade on 5-minute bars, right? And what I want you to understand is that that's not a flaw in the market. It's the market working correctly, if we're being honest. But yeah, so that really is. I want you to understand. Don't blame the market. That's just how the market is supposed to work. Okay. But so as you see here, that's the exact pattern that we have, right? These two signals that we have, they're just structurally harder to replicate than a simple opening range breakout, right? And so it's possible to find an edge in them that's not already been arbitraged away, okay? So what does this mean for systemic traders, okay? So 5 things I want you to take away from this. 1, single bar open, high, low, close volume patterns on liquid futures do not survive realistic friction, okay? This is structural. It's not bad luck. It's structural. And I'm just going to tell you that straight up. It really is the case, okay? That these simple strategies that you see online, not profitable at all. At all. I promise you that, okay? Number 2, walk forward validation is a non-negotiable, okay? In-sample results are not evidence of anything at all. You need to test your data out of sample. It has to be tested on data that it hasn't seen before, or else it's just cheating, okay? Number 3, a T-stat below 2.0 is a fail. It's not a partial win, it's a fail, okay? You have to take that into account. It's not a maybe, it's not this, it's a fail. It has to meet that requirement. We need to set strict rules that we need to pass, okay? Number 4, negative results are valuable, okay? They really are. They basically map the territory that does not work, right? Which is genuinely useful information. And that's what we want to do. We don't want to waste our time doing things that we know are never going to work, okay? And number 5, genuine intraday edge requires either data that is not publicly available, regime detection that goes beyond price and volume, or execution advantages that retail traders just don't have, right? And I'm not saying I'm just telling you, I'm not saying all this to bring you down, tell you it's not possible, but it's not as easy as it seems, right? I know a lot of people that my age that think trading is so easy, etc., blah, blah, blah. That's just not the case. And the numbers show it, the facts show it, the statistics show it, right? That's just how it is. It really is. But that is what I want you to take away from this, if possible, from today, from my paper, from my video. And so basically, I think it's important to point out that this research is ongoing, of course. So this paper is the foundation of a larger research program, right? As I said, this is paper 1. Papers 2 through 5 go deeper into specific phenomena, right? We have a regime classifier that describes the market accurately, but cannot trade it profitably. We have machine learning architectures applied to bar sequences. We have cross-session structure in gold futures and Asia session dynamics, all that. But not all of them end in failure, okay? I do want you to know that. Some find something real, for sure. And if you want to follow along, the full paper is, like I said, linked in. I'll try to link it in the description. It's also on my YouTube accounts. It's on there. I've also shown you where you can find it at the beginning of the video, but it's all there. And next video is about a signal that works perfectly as a description, and it just fails completely as a strategy. Okay, and why that distinction is just one of the most important things I learned in this whole project. Okay. But like I said, this is my first video. I appreciate you guys for watching. I hope this was educational. That was my goal, is to have this be educational. Like I said, this is just a better way for me to break down my papers. So if what you saw here was interesting, you can just go read the paper in more detail with the actual numbers, etc.